On this episode of Passive Real Estate Investing with Mavericks, it's another Freedom Friday with myself, Neil Timmins, and Ava Bouwkamp. Coming right up today, what are the benefits of passive real estate investing?
Hey Mavericks, this is Ava Bouwkamp, and this episode of Passive Real Estate Investing with Mavericks is brought to you by Legacy Impact Investors. We are an industrial investment firm located in cash flow country, the Midwest. We strive to shield off risk and beat inflation, all while producing predictable cash flow. We curate real estate investment opportunities for busy professionals and other real estate investors seeking passive income. To learn more about what we do and connect with me, go to www.legacyimpactinvestors.com.
Maverick, noun, unusual person, a visionary, leader, go-getter, an independent thinker. They see the vision for their life and pull that future towards them with an unyielding belief that things can and must be better. They achieve what most won't. Innovative, influential, daring, and direct, with a remarkably high tolerance for taking calculated risk. A foe to the status quo. This is Passive Real Estate Investing with Mavericks. Your host, Neil Timmins, has been involved with over $300 million in real estate transactions. He's a published author, commercial property investor, and real estate syndicator. This show is for those who want to learn how to earn passive income through real estate investing. Now, here's your host, Neil Timmins.
Welcome to Passive Real Estate Investing with Mavericks, where we provide actionable steps for you to grow your passive income and become job optional. During today's episode, we're going to be talking all about the benefits of passive real estate investing. For those of you who are new here, I'm your host, Neil Timmins. I love passive income from real estate. Now, before I jump into the show today, I want to make a request that if you like what you hear, well, give us a thumbs up or subscribe to the show. Never miss a valuable episode. And if you love what you're hearing, well, give us a written review. Plus, be certain to take a look at the description of the episode because we packed it with thousands of dollars in free resources. So it's another Freedom Friday, Financial Freedom Friday, and I've got Ava Bouwkamp here with me, and we're going to be talking about the benefits of passive real estate investing. Ava, how are you?
I'm doing great. How are you?
I'm doing terrific. Thanks. Hey, I'm excited to hear. You know, we talk about, you and I and folks who invest inside the industry know there's a whole bunch of benefits of passive investing. And so for a lot of people on the outside in, if they haven't placed an investment, or maybe they have, they get regular cash flow, and cash flow is obviously probably one of the largest benefits of investing and passive investing at that. But there's a lot more benefits just than cash flow in there.
That's for sure. There are a whole host of reasons why passive investing might be a great fit for you. It's made tons and tons of people lots of money through means other than just cash flow. And so that's one of the reasons we wanted to take a couple of minutes to talk about it, because if you're new to the space or maybe unfamiliar with the concept of passive investing, we want to make sure that you have a wealth of knowledge so that you can invest as an educated investor. We want to make sure that you're able to maximize the dollars you place just beyond cash flow. And so that's what we're here to talk about today.
Yeah, and let me set you up for, if folks have listened to previous episodes, they know who you are, but maybe for the audience's benefit, maybe I'll just describe your role. You're the head of investor relations for us, for our firm. Yours and my firm here at Legacy Impact Investors, and you often interact with and are the point person for investors who invest with us. And you educate and you communicate with them on an ongoing basis about what it is that we do and what it is that our investments do, and then ultimately their investments do for them with us. Fair to say?
Yeah, I think that's a great summary. My role is really to help serve our investors, build a relationship and connection with them to make sure that they feel comfortable with us They have a complete and full understanding of the investments that they might make, they might be interested in making, and really helping people achieve their financial goals is what I'm all about. And really connecting, I like to think of it as a connector. I help serve as the connector between passive investors that want to get into these kinds of opportunities. And I just facilitate and connect them with the opportunities that are available to them. And so that's what I'm all about.
Hey, fair to say that you mentioned something. I just want to elaborate upon it. You help people reach ultimately their financial goals. And sometimes that means not investing with us.
Yeah, I think the most important deals are the deals that you do not do. And so it's extremely important for investors to be educated and smart and able to interpret the data that they receive for themselves. We see a plethora of people on the internet, on social media, making claims, making promises. You'll be able to double, triple your money in 18 months, all of these crazy timelines. And as an investor, you need to be able to look at that with an extremely critical eye, because your dollars and your time is on the line when you invest with someone that either you don't have a good understanding of what their track record is. They might be making claims that are built on faulty assumptions. And so as an investor, you really need to be able to interpret and understand what you're getting yourself into.
Hey, and at the end of the day, for some of the things that we put together that we offer investors, what they want to do, what they want to accomplish, what we do just doesn't line up real well with them. And it just depends on everybody's goals, everybody's situation. And sometimes it means we don't line up with them real well today, but it doesn't mean we don't line up with them well 6 months or a year from now, as both of us end up on paths that sooner or later may come back, and timing just lines up really well at a future point in time.
Yeah, definitely.
All right, so let's jump into the benefits. Inflation is a very serious subject matter right now. The word inflation hasn't come out of people's mouths, I think, this much since the 80s. And so it's a big deal for what's transpiring in the actual market. All of us are paying a whole bunch more for goods, for services as a result of inflation. And at the end of the day, real estate is a really good inflation hedge.
Yep. Let's actually put some numbers to that. So before Neil and I hopped on this podcast, I pulled the numbers again just to make sure they were as fresh as possible. So according to the CPI inflation calculator from the U.S. Bureau of Labor and Statistics, $1,000 in 2018 is worth $1,223.89 as of April 2023. So $1 today buys 82% of what a dollar could buy in 2018. That is an insane amount of inflation over just 5 years. $223.89 more for $1,000 in 2018 to today. So maybe you could talk a little bit about how real estate, really tangibly, how does buying an asset help hedge against those kinds of inflationary pressures?
Well, there's multiple ways. The biggest one being the replacement cost of properties. So, for example, what you just said, buys 82%. So it costs more to build a new building today than what it used to in 2018, and probably by much more than that number that you just provided in terms of the global cost of goods, because inflation has run rampant in labor and then also in materials, and that shows up in the cost associated with building a new property. So when we go in and want us to analyze a non-new property 10, 20, 30 years ago, oftentimes we are locking in the costs associated with that property. The building costs were very different 10, 20, 30 years ago. And as a result, when we can buy it at a discount to new property that costs so much more, we're locking that in. And as a result, as inflation increases, new construction prices increase, our building that was built 20 years ago also increases, because what it costs to rent a new property has to go up, right? If the cost of construction of a new property has increased, to rent that property increases as well. And it pulls everything else below it up, all the older properties. When I say older, doesn't mean old, just means non-new. And so we end up with a tremendous rental rate increase and a replacement cost scenario that becomes a hedge for us, that we ride that wave up. And so it's a terrific spot to put dollars and cents to protect yourself against your dollars eroding as they sit in a bank account. Because today, inflation might be 3.8, 4%, somewhere in that range, and your average savings account is not paying you that. The CD may, but an average savings account is not. Therefore, every year we're going behind. That dollar, the idle dollars go behind in your purchasing power. They're worth less than what they were worth a year ago.
Yeah, definitely. I think an easy way to think about it is just like a house. I grew up in an old home. And so when that home was built, it cost maybe $30,000, $40,000. At the time, it was a beautiful house, $34,000, $40,000 to build. And today, you're not building a house for that much money. So you just apply that same principle to any kind of commercial real estate asset. And the concept holds true all the way through.
Yeah. How about diversification? If we look past inflation and look diversifying one's portfolio between all the things you can do, the biggest ones being, of course, stocks and bonds, the two largest investment categories, asset classes. Real estate provides a very large diversification play that is also the correlation is very different between real estate, certainly private real estate, and stocks and bonds. Is it fair to say that the overall environment and the way that things trade just looks completely different in real estate versus stocks and bonds, and how they move together, I guess, from the correlation standpoint?
Oh, absolutely. In an inflationary environment, that is actually a plus for people who own real estate, because when you're in an environment like that, your property value goes up as well. And so when the stock market is going crazy, and if you keep an eye on any sort of numbers from the S&P, the Dow Jones, everything is all over the place. You've got tons and tons of huge tech stocks that provide a lot of variance and a lot of volatility. And so real estate is a great way to make sure that you don't have all your eggs in one basket.
Yeah, and the correlation is very different. So just because stocks are up doesn't necessarily mean real estate's up. Just because stocks are down doesn't necessarily mean real estate's down. There are different levers and pressures that affect each of those between stocks and between real estate.
Yeah, and that's not to say real estate always goes up. I think that's a common narrative. You hear
right.
People, they're going to drum that real estate can only ever go up. And over a long time horizon, that has shown to be true. But I think it's good to be cognizant of the fact that you still have to utilize smart investing principles, even in real estate.
No doubt. There are cyclical pressures inside of real estate. You want to be cognizant of that. And when one is mindful of that, it actually creates better buying opportunities when they know how to apply that.
Yeah, absolutely.
Do you know what the largest single cost each of us as individuals has in our entire lifetime?
Taxes.
Taxes. Number one, largest cost each of us will ever pay out of anything else happens to be taxes for us in this country. Tax benefits are a giant plus, a giant benefit when it relates to investing in real estate. You've got depreciation, the ability for us to depreciate a building over a period of time allows us to offset the income that may come in. And there's a couple other things that we can do to even amplify that. A cost segregation study, which simply means that we just break the pieces of a building down, right? And from a whole building down into little bitty pieces in which we can use the tax code to actually depreciate that faster. So we can actually front load our tax benefits by showing bigger paper losses. And these are all things. Yeah.
They want you. The IRS wants you. They are incentivizing you to own real estate because they don't want to find places for people to live. They don't want to find places for people to store their stuff. They want someone else to be responsible for that. So you have to look at where are the incentives placed and where can I leverage that. And cost segregation studies are another thing that the IRS, they want you to take advantage of that. And so it's a tool in our toolbox that can be a great benefit to passive investors.
Are you a passive real estate investor seeking financial freedom? Well, today's market's unique and it's ever changing. Now is the time to get educated on how to strategically invest in commercial real estate for long-term financial freedom. Grab your copy of How to Passively Invest in a Changing Economic Environment. Go to www.mavericks.invest.com. You're right about that. They get what they reward. They're rewarding people to go off and invest in real estate. And so as a result, it spurs growth, it spurs activity. It's a giant contributor to economic growth and to to employment in this country. They want more of it. And as a result, they put these little pieces in place that those who are inside of our industry certainly are very familiar with, and that passive investors can take advantage of. These are inside of investments that we place. All these things become automatic for us. Cost segregation studies, we just do these as part of our investment principles and business plan. And something to be mindful of are the tax benefits associated with this.
Yeah. And when you get to a certain income, tax planning becomes super important. So we already touched on this concept a little bit, Neil, and I want you to speak a little bit more about the value of appreciation as a benefit of investing in real estate.
Well, you said it. Over the long term, prices and values and real estate becomes a safe, sound to place dollars and cents, and appreciation is a big benefit. A big one derives the benefit of appreciation because over a period of time, real estate is historically appreciated. They go up. And your example, your family home, that is older, and certainly things look very different. We all have either ourselves or our parents or our grandparents. We can go back in memory to go, oh, that house cost me X. And you're like, how is that even a real number? Because cars don't even cost that, right?
Mm-hmm.
And that is all, right, a combination of appreciation and inflation fueling part of appreciation. Things go up over a period of time. And certainly inside the commercial real estate space, when one can either naturally get the income to increase through to standardized rent bumps or force that appreciation through strategic business execution to get the income higher, right? To think about changing a dilapidated property into a pretty property, and now it becomes more leasable at a higher rate. Therefore, the income has gone up and the building's worth more. And that is, as investors, one gets the benefit of that appreciation over a period of time.
Yep, which comes in handy at sale or refinance, and that can be leveraged definitely by the operator to be a huge benefit to passive investors.
Yeah, there's no doubt about that. Another benefit is so many people, they think, I want to be involved in real estate. I'd love to participate in something, but it's going to cost me too much money. Meaning it's going to take all my cash reserves. I got to have to do a bunch of things. I'm going to have to go sign up for a mortgage. And it's just not the case. The ability to participate in a transaction in the commercial real estate world, it doesn't necessarily need to break your bank, if you will, use it in quotes, is that to participate in what we do as syndication, it requires much lower minimum investment requirements to be able to get in, to tap into expertise inside the industry versus having to go solve it yourself, or certainly having to take down a big deal by yourself.
Yeah. And then also you're able to access and really reduce your risk by involving other people in the deal. Commercial real estate is a team sport. Nobody is going to be the one-stop shop for every component that's needed to put a deal together. And so by involving other investors, by involving experienced general partners, you're able to harness and access the insight, the knowledge, the resources, the connections from tons of other people. And that really is a huge benefit to mitigating risk in a deal by having lots of other experienced participators in the opportunity.
Yeah, no, there's no doubt about that. The ability to be able to get involved. And you mentioned something, it can reduce your risk. Or I'll take that one step further. Your ability to have reduced minimums allows you to diversify into multiple investments, therefore reducing your risk. It allows you to put your eggs in multiple baskets.
Yeah. Absolutely. All right. I'm not here to fearmonger, but I thought this headline from CNBC from this February was quite something. It's something to just pay attention to and is probably top of mind for a lot of people. So the headline of this article is retirees lost 23% of their 401k savings in 2022. That's nearly a quarter of the value of that 401k account. And Fidelity in that article goes on to say that nearly half, 48% of retired Americans believe that they will outlive their savings. So that's a lot to think about, a lot to digest. Can you touch on how investing in real estate, passive investing in real estate, might be used as a strategy for saving for retirement?
Yeah, well, one of the old strategy, I say old, the strategy that's been around for a couple of decades at this point has been the 4% rule. Right? The idea being that retirees can withdraw 4% of their portfolio each year with a very low probability of running out of money, meaning they can put this thing 30 years out or so with a very low probability of running out of money. The challenge with that has been up until the last 12 or 18 months, we've lived in a very low interest rate environment for years. And so the idea that retirees can effectively employ their dollars and cents, their investment portfolio, in order to achieve that has been eroded. And so where can real estate help add that idea that real estate can produce passive income and at the same time appreciation, right? So the ability to find the right opportunity can allow you to cash a check that's way bigger than 4% of the investment. And at the same time, that investment, you're not drawing on the principal. That principal is, in fact, growing through appreciating inside of real estate. Now, I wouldn't expose myself to putting all my eggs in one basket again, but perhaps a portion of it that allows somebody to combat what's taking place, both inflation and so now we have increased interest, great, but we still have inflation much higher. So in fact, we're almost no better than what we were given an apples to apples comparison, which is how do we grow our dollars above inflation? And so the 4% rule has become under significant pressure in the last handful of years. And now the new conversation with inflation is going to become under a different kind of conversation too. Can retirees, dollars and cents, extend to the end of their life? Because what we have been seeing is that interest rates have been too low. Now the new conversation is that inflation is too high. And so the dollar, the purchasing power just doesn't go any further. But with advances in medical technology, people keep living longer.
Yeah. No, that's great. So I just want to kind of put a bow on our conversation today. We talked about all of the other benefits to investing in real estate, even beyond cash flow. So we talked about inflation, how real estate helps combat and hedge against inflation, diversification, the tax benefits of investing in real estate, appreciation, your ability to participate and access real estate opportunities, and then how those might all help kind of merge together as a feature or a tool of a retirement plan. So, Neil, do you have any last thoughts before we wrap up today?
The big one is if this has been valuable, maybe want to learn a little more, we've got a white paper available on our website, how to invest in a changing economic environment, which certainly we're in today and an ever evolving. And the best place to get that is www.legacyimpactinvestors.com. And you guys, the link is below in the show notes for you. Been a great episode, Ava. Thanks for joining me on here. Until next Friday, we'll see you guys soon. To our listeners, pat yourself on the back. You guys have made it to the end of the show, and most people never finish what they start. If you receive value from today's show, be sure to share it on LinkedIn, your Facebook page, or your social media platform of choice. Subscribe to never miss a valuable episode in the future. And if you found value in today's episode, give us a thumbs up with a positive review. If there's a particular topic you'd like to hear about, well, I want to hear from you. Shoot me a message on LinkedIn. The link to my profile is below in the show notes. You can connect with me there for more valuable content.